Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Looking at this market, we can view the whole action from the heights of March all the way down until the May low as a large bearish halfway hesitation. It was indeed one of the most gratifying moments in recent times to see prices drop down to reach the target and immediately shoot back up again. The subsequent juddering rise pushed up through the congestion and trend lines plus the middle time, currently 1838, of the March to April bearish shift pitchfork. This pitchfork has, and still is, significant, as it was the combination of the 50% Fibonacci line of the June to October 2018 move at 2221 and the upper time, currently 2054, of this same March to April bearish shift pitchfork that capped the rise. We saw prices drop down in early June, such that we are currently sitting in between the middle and upper tines. That's after only 2 weeks ago, testing the middle time once again. As I said last time, and I quote, "Overall, we're in another fairly free area below the January 2020 high at 2039. This brings me to potential patterns in the offing." End of quote. What the market has chosen as a recent pattern is yet another bearish halfway hesitation, a fresh one. So where are we looking below? Well, the question is whether the measure from the May high at 2333 or the April high, which is at 2488. I will disclose both and let you see what you think. For the May high, we had a target in the 1950 area, whilst the April high would have a potential target X in the 1800 area. Why didn't I label the May high bearish halfway hesitation on the daily chart? I hear you say. Well, it is simple. We already reached that 3 weeks ago. Question now is whether that move down to 1950 was enough and all that was seen since is just a follow-through, or is the potential target in the 1800 area for the larger bearish halfway hesitation, is that still a viable target? We'll have to wait and see on this one. Finally, I've been trying to nurture an idea I planted in your mind, well, many, many weeks ago. It was to regard the whole action of 2022 so far, even perhaps going back to November last year, as a possible diamond pattern. Now, this idea seems to have fizzled out, and I will not mention it further unless it manages to raise its ugly head again. LME 3-month tin. The reactionary rise through May and into early June was muted. Prices managed to break the then March to date downtrend, but then failed to exploit the break. And by mid-June, we had the consequences. The market reverted back down and carried on lower until towards the end of June, when prices dipped heavily through two congestion bands, one from February 2013, which stretches between 24,750 down up to 25,050, and another that is more spread out in time, and it stretches between 22,900 and 24,155. Now, this latter one has the following significant levels within it: the July 2014 high at 23,070, the May 2014 high at 23,500, the April 2014 high at 23,855, the October 2013 high at 23,970, and the March 2013 high at 24,155. The dip made that day penetrated all of these, but failed to break through the actual bottom of the support. Plus, the market reverted back up in disappointment. It created a bull hammer that saw, let's be honest, a 2-day, maybe 3, disappointing move higher. What was interesting on how the move lower happened was how it was the first, and so far only, market open that is, below the middle time, currently 22,190, of the rather acute bearish Andrews pitchfork for the mid-April to early June action. And that's the one I drew a few weeks ago. I've previously said of this bearish pitchfork, and I quote, "It is very acute and therefore likely unsustainable, but it gives an idea of what we may be looking for on the downside. Thus it seems an open," end of quote, "thus it seems an open below the middle time can cause such a reaction in the market." It's something to remember. Now, I also posed a question a few weeks ago as to whether this action since mid-April was a possible bearish halfway hesitation. And the answer to that was yes. The downside target X for this move was in the 26,000 area, and it was reached the day before the big hammer pattern. So this explains the move lower and the strong dip. But what about what has happened since? And what may happen? Well, we've gone roughly sideways with a bearish tinge, testing the congestion from February 2013, but not enough impetus as yet to reach down and test the next and obviously tougher congestion zone between 22,900 and 24,155. This doesn't mean that the market may not do so. No. We do have, I suppose, a time limit on this, as within the next week and a bit or so, prices will meet the descending upper time if I just carry on sideways. And that's the upper time is currently at 28,215. And that's of the same bearish Andrews pitchfork. This brings me back to my final words from last time, and I quote, "It will now depend on who wins between the heavy-duty support and the bearish Andrews pitchfork." Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.